Okay, what's going on, everyone? This is going to be the next edition of the playbook. This one's going to be on finding points of interest. So what I'm going to do is just bring up a gold chart. This works on anything, really. It doesn't really matter about the pair. Gold, it moves just a lot faster than currency pairs, but you'll find that is just simply pure price action that will be evident on all different anything you want to trade. It's typically how price just moves. Okay, so this is going to be like my view on what I look for when I'm starting my day. So you can see up the top there's a heading. There's Dojis, liquidity candles, imbalances, session highs, lows, 50% points. These are going to be not all of them, but there's going to be some of the very common ones that I'll be looking at. You can also include there like double bottoms, double tops as well. So first thing, what we're going to look at is sort of understand that the market moves from liquidity point to liquidity point. There are some price action points that we'll see, like this our typical retail traders will trade, that you'll see where there's like double bottoms, double tops, dojis. Like if we can see it, and if it's logical to us as a retail trader for where we put our, typically the way most people will learn, if you see things like double bottoms, double tops, and there's just a whole bunch of strategies built around them, you know where the stop losses are and the stop losses are going to be placed, right? And if we know how to do that, that means like institutions know where they are going to be as well. So this is where it becomes very easy to become trapped. And if our stop losses are all put in a particular point, then that's where liquidity is lying. So you don't want to become the liquidity for price to move in a particular direction. And that's where a lot of traders get themselves into trouble, is that their stop losses get hit just as the market starts to turn and go in the direction that they intended, except for they've been stopped out first. So that's what I mean by you become the liquidity for the move. And it's a very common thing. I always hear it that, oh, my stop loss just got tagged just before it moved in my direction. So let's dive deeper into that. So what I'm going to do is first of all, we can see, like, let's just point out what some dojis are. Dojis are going to be candles. Let me just change the color. Dojis are going to be candles that have wicks, or more or less equal size wicks above and below with a small body. There's going to be a whole bunch of different types of dojis that you will come across. So I'm just sort of circling a lot of the dojis that I see. I'm not circling all of them, but I'm circling many of them. And you see, like, they all, how prevalent they are. There's just tons and tons and tons of them. So notice how, like, they've all got quite wicky tops and bottom wicks. They can be bullish or bearish, or can they be completely neutral. Let me just draw some. So more or less, I'm looking for candles that look like this. Some might have a larger wick on one side than the other. And some may have no body whatsoever, could just be a straight line. You'll find Japanese candlesticks, there'll be a whole bunch of different names, like gravestone doji, dragonfly doji, whatever. They're all the same, roughly. And it's important that we understand where they occur in the chart, because a lot of the time retail traders, it's a buildup of liquidity. A lot of people say, it's indecision, but we know that when you see a doji, like say there's a common common price action pattern called morning stars, and a morning star would be two impulsive candles pushing down. Then we'll see like a little doji, and then we'll see an impulsive candle push up, and that would be a morning star. Now, a lot of traders would see that and then say, okay, when price is crossing the high, they'll put their stop loss underneath it, and they'll try capture that part of the move. Now, this is very common, that what will happen is price will push up, come down, take the stop loss, and then go up. Okay, so that'll be one thing that I'm looking for, is just I'm trying to identify where the dojis are in the charts, because that's going to be a place that I know is going to be often stop losses and entries built around that. Next thing, what I'll be looking for as well is just sort of understanding like where the double bottoms are. So this would be an example of a double bottom or a double top. Very common pattern in Forex. And if you have a double bottom or double top, this could be a sign of, like, say, a double bottom would be like sign of seller's exhaustion. And for a double top would be a sign of buyer's exhaustion. Now, a lot of traders would be looking for a bit of a retracement, keep the stop loss above here, enter somewhere here if they're using fibs or 50% or support resistance or whatever it's going to be. Then they'll be looking that stop loss goes above here, entry be around here somewhere, and then they're looking to target down the bottom somewhere. So that's all well and good, except for stop losses. There'll be a heavy concentration of stop losses above here, and a very common pattern that you would see is when price looks like it's going in your direction, comes up, wicks you out, and then goes. So we know that double bottoms, double tops, there's going to be liquidity line above and below them. Same with Dojis, there's going to be liquidity line below the Doji. And often once the liquidity's been taken, that's when you do get the cleaner move. So with that in mind, okay, so that's like some of the common price action candles and formations that I'll be looking for. Another thing that I'll look at is session highs and lows. Now I've got a video on that. It's called Understanding the Different Sessions. Now you've got the Asian session, you have the London session, we've got the New York session, and just here, what I'm going to be using, maybe this is a little bit different, is that I'm going to actually look at the Euro session as well, just the Euro Open, commonly known as pre-London. So let me just type that in there. So pre-London. I'm not going to go into the times. The times are going to be in the other video, so go back and have a look at that one. Okay. What I'm going to do though is put up the sessions on my chart. So this, you see the different color schemes. The blue is the Asian session. Blue is Asian. This little tan color, this is my Euro. So it's just the 2 hours, the 2 hours before London Open. Okay, London Open being 8 a.m. UK time. The pink is London. The green is NY, New York. Now, where it's got a little bit of a darker shade of green, this is going to be the London-New York overlap. So when London finishes here, and then after London finishes, then it's solely New York. But at this stage, London Open, what I'm going to refer to is just when London is open. So between like 8 a.m. London time and 1 p.m. London time. 1 p.m. After 1 p.m., that's when New York kicks in as well. And now you've got you'll be trading with London and New York. Both sessions are active at the same time. Okay, so when I'm looking at session highs and lows, what I'm looking at, let me just go to today. I'm going to use this for example. So actually, no, I'll do that later. So this is the London. This is today. This is today being October 20, 2022. This was the day from the start of the blue bit to here. We're just about 1 minute till we have the daily close. So it's more or less going to finish like this. Okay, so one thing I'll be looking at straight away is this is the lowest point of Asian session. Okay, so currently as I'm trading, what I'm looking at is putting a line there, and I'll be calling that my Asian low. I'll be looking for before pre-London kicks in, or Euro, same thing, pre-London and Euro. Well, I'm considering the same thing. Before it gets to that point, I'm looking for my Asian high. So it's going to be at closing at 6 a.m. UK time. Okay, 6 a.m. UK time is going to be the end of my Asian session. So whatever the highest point before 6 a.m. London time is going to be my Asian high. So let me just mark that. Okay, that's going to be here. That's going to be my Asian high. Now, liquidity is often going to be sitting. If it's a trending Asian session, then the 50% mark of the session is going to be where a lot of liquidity is pulled. If it's more of a consolidation, I'm not too fussed about putting in my 50%. But if I have a trending Asian session, then I'm going to be looking at where the 50% of the Asian session is. Okay, so what I'll do is I'll just measure. You can use a fib if you want, or just measure from high to low. See, this is the halfway point. Halfway point, price 1627.782. So let me just copy some of that across. 1627.782. Now, liquidity is going to be for the start when the day starts. Your Asian session is going to be where liquidity is built up above and below those sessions. Okay, so there's going to be liquidity line underneath the Asian low, and there's going to be liquidity sitting above the Asian high. Now, price will often take liquidity from above or below, and then it will go to fill either an imbalance or go to like a level of support or resistance or some area on the chart. So what you can see here is as the Asian session developed itself, okay, so it sort of trended down for a little bit. I'm not going to do like supply demand, support resistance, or market structure too much, but that is going to become important. That'll be topics of another video. But down here, there was a heavy level of support down around the 1623 area. Price finds a support, and then what we do is we get one of these liquidity candles. Okay, liquidity candle means it's basically like an engulfing bar, bullish or bearish engulfing bar. So what it's done is it has wicked down below the previous candle and then ended up so it looks like it's breaking to the downside. This could be a bit of a seller's trap. So people could be looking forward, thinking that it's breaking the low of this candle and now it's going to go down and continue down. So this is triggering liquidity into the market. It's picking up early sellers, and those sellers are going to get trapped now because it's pushing down, triggering sell orders, and now it's pushing back up, breaking the high of the previous candle and finishing a strong bullish candle. So this is a bullish engulfing bar. I'm going to call it a liquidity candle because it's grabbed a lot of liquidity from sell side and now closed bullish. Okay, so it's sort of signaling to you where the order flow is going right now. So there's a good chance that if this was a point of interest, a zone on a higher time frame, maybe down this area, there's a very good chance now that if this is candle closing bullish, that something's happened in the market where the order flow has shifted. This candle in itself has created a level of support. Now, we're not really interested in trading this specifically, but I'm more or less waiting for the Asian session to complete because I'm not really interested in trading gold during the Asian session. But there's this is a pretty nice session. Like actually, there's 100 pips in here. This is quite a lot of volume. It's not my trading session. I'm mostly focused on trading either London or New York. So I'm usually waiting for Asian session to finish. This Asian session is going to give me a lot of information on how I want to plan my day ahead. So Asian session's created a low. It's pushed up and it's created this is my Asian high. Sometimes the Asian high is created in the center of the session, not necessarily in the last few minutes of the session, but in this case it did. Euro Open has opened, and what it's done is it's grabbed liquidity from above the Asian high, and this would be another buyer's trap where people are thinking that, okay, they're so bullish and now the new session's coming in and looks like it's breaking to the upside and it could continue. But what it does is the way the market moves is that it takes the liquidity from above the Asian high and it has a pullback. So it's taken the liquidity, it's formed a little resistance, and now it's pulled back. And it's going from one liquidity point to the next liquidity point. We know there's a bit of liquidity sitting right here where the Asian 50% is. Now there's a couple other little things about this candle, kind of overlapping some things. I'm just going to talk as I see it, is that when this candle is also another liquidity candle, as in what it's done is it's broken the low of the previous candle, only just. If we look up this top left corner over here, we're going to see the open, high, low, close values. So the low of this candle is 16.25.265, and the low of the next one 16.25.222. So it's only just lower, but it is still lower. So what it's done is it has broken the low of this little doji candle. Remember what a doji candle is, what I said at the start. It can be an area where liquidity is built above and below. So it's grabbed the liquidity below it and then finished bullish, pushing up with a lot of strength. A lot of strength. Now, this candle, not only is it a liquidity candle, but what it's done, as it's pushed up, and the next candle has wicked down and then started pushing up again, it's left an imbalance. So an imbalance is going to be an area. You'll notice where a lot of these candles, when they push down, the wicks will match up. I'll do another video separate on these, but where these wicks are all matching up, we generally, an efficient market is generally matching, right? So we're generally getting candles that are going to say push down. Here's one candle, next candle pushes down, next candle wicks up and then starts driving down again. Next one wicks up, starts driving down again. So you'll see, like, this is an efficient market where the wicks on a candles before and after are more or less lining up. When we get something that pushes down, next candle wicks up, goes down like this, a lot of strength, wicks up a little bit and then pushes down. This is an inefficient market. So what this is meaning is that there's a lot of sell orders that's driven price down, and we notice that these wicks aren't lining up. So this is giving us a bit of an imbalance. Okay, so what the market will often do is at some stage, it'll want to come back and refill this imbalance to make it more efficient. So one way is we can be looking at, so sometimes it doesn't fill it in one go. Sometimes it comes back to like 50% of it, and other times it can more or less fill it completely. So one other little area of interest is going to be the halfway point of imbalance. If I see an imbalance, the halfway point, or even the high, like the top of the imbalance or the bottom of the balance, they're going to be also points of interest that I'm looking at. So what we see over here, when this candle had pushed up, the next one wicked down and then drove up again, it's left an imbalance between these two wicks. So there's a liquidity line here, and this time it's actually lining up with my Asian 50%. So we've got a couple, we're starting to get like a little confluence of reasons that maybe as we've taken that euro high, this could be a point that price is going down to. And then maybe if it gives us the right confirmations, if we think it's going to be a trending market up, then this could be an area where we could start to look for buys. Not jumping in for buys without confirmations, but an area where we start looking for confirmations. Another thing that's happening here is that what we can do, like what I did for the Asian high and Asian low, is that we've got the euro session. So the euro session, we've got the euro high, the euro low. It's only a small session, it's just 2 hours here, the pre-London. So I'm not actually looking at doing like a 50%. I'm more or less just sort of visualizing that often euro, this would be considered like the pre-London pullback. We often get a pre-London pullback. Is that it's taken the Asian high, it's pulled back, and then here was the low of that the euro, the pre-London, okay, the euro open. London session, then what it does is it takes the euro low and then forms a rejection candle. Or a doji, you call it the same thing, rejection candle, doji, same thing. Now we know there's going to be liquidity sitting above and below here. Okay, so often once we've taken the liquidity, you see how this next candle comes down, wicks all the way down to the bottom, and then starts to push back up. Now what we could do is we could look into this candle, the lower time frames. I'll do that on another video. I don't want this one to go too long, but I'd be quite interested if this takes the euro open and we're pushing bullish and we're at the little level of support, there's a good chance that we could take the liquidity, that sell side liquidity from under the euro close, the euro open, and then we could drive back to an opposing level, which would be just your opposite side, opposite resistance. Now, that could be like a little pre-market, pre-London trade right there. Or what we can do is just like, as time goes by, we can just start to just see how the price behaves. And it's quite regular. So we do this pink area, this can be our London open. So what I'll be looking at is putting a low. Here's my London low. I'll just type that in. London low. I'll do the same thing for my high. There's my London high. And then for London open session, like between 8 a.m. London to 1 p.m. London, I'm also going to do my 50%. Okay, so let's go from the low to the high. See like the 50% over here, so that's going to be 1633.32. So 1633.32. That's going to be my London 50%. I'll label this as my London 50%. London 50%. Okay. So what we've got now, you see how like we've got the London high here, and that's at 12 o'clock UK time. Price forms a little doji here, and then we've got another little doji for NY session. This is the start of the NY session. So what we're doing, if we remove some of this data, yep, that's fine. So at this point, if we don't see this area, come on. All right. If we don't see the future, what we've got here, we've got dojis. So we know what's building up above and below dojis. There's going to be liquidity. And this would also, if you could say that this, if on the lower time frame, if we looked at this is a 30-minute time frame, say we go to the 5-minute time frame, what we've got here is starting to become another pattern where it's, some people call this divergence, some people call this a head and shoulder, some people call this a W pattern or a double top. It's all signs of buyer's exhaustion right now. So one thing people would be doing is say this here, say you got the double top. Let me just clean this up. Say you got the double top. And then here, what this did was a bit of a break of structure. So what it did is it started to break, like here's a support here, little supports here, and then this could be the break of structure. And now you come up, retest the highs, and then looking to go down, stop loss above the London high, and then you're looking for downside. But what happens commonly is that price will push up and you'll get stopped out first, and then it'll go your direction. So why did this happen? So how can we anticipate this to happen? So remember, it's about time in the market and time in the market. So if we go back to the 30-minute, where we've got the London high, it's better to wait for the London high liquidity to be taken, and then once the liquidity has been taken, then it can go to the target. So this wick here is the one, this is the liquidity candle. So what we're doing, we could be waiting for a liquidity candle to wick up, break the high, and then look for it to take the sell. So that would also be now a point of interest. We're waiting for price to take the London high, and then looking for that liquidity that's been taken, for it to go from one liquidity point to the next. Where would the next one, logical place to take some profits, would be the London 50%. Okay, now where else could it go? In here, we've also got imbalances in these candles. Okay, so there's imbalances here. So this one here, like this market didn't move that efficiently. So it makes sense that if we're going to look for at this stage, the market has been trending. Okay, the market has been trending. Let me just fix this up. Market has been trending quite nicely for this particular session. It's a downtrend overall, don't get me wrong, but for Asian session, we've pushed down, hit a liquidity point, higher time frame supply. Now, demand zone support. Price has pushed up, had a little pullback for London. London started pushing up, and then this wick here would have triggered buy stop orders. So this would be buy side liquidity that's been taken. It's a point of liquidity across the left hand side as well. You can see that point of interest is that this was a order block. So it makes sense for NY session. If you're hunting buys at this stage, you're better to wait for the pullback. If you're looking for sells, wait for the liquidity to be taken up the top. So as it got taken and pushed up, then if I go to the lower time frame, let me go to the lower time frame. When you're trying to time it, you can see like how there's all these dojis being formed. So it's nicer to say, okay, well, if I've got these dojis here, I know there's liquidity sitting above it. So risky entry is instead of selling here and putting a stop loss here, is actually sell here and target down here. Keep your stop loss. If it's going to keep on going, it might not work. Give it like 15, 20 pips stop loss above, like where your stop loss would have been normally, is where you could try putting your entry instead. Stop loss, if it's going to just keep on going, then you're kind of relying on that it's not always going to work, but when it does work, you're going to be getting a nice tight stop loss, and the risk reward, even just down to here, is going to pay off for those ones. So you're going to get a nice risk reward trade if taking partials here, and then maybe you've got a further target. Now, what about buy side? Because we're looking at a trending market here. We know we have a imbalance across here. So let's mark that imbalance. What we also have is a doji across here. So there could be liquidity sitting underneath here, or it could be coming back to this imbalance to fill. So I don't want to just blindly enter a buy limit here or enter market here. I want to wait for confirmation. So this is just a point of interest. I'm just looking for a reaction at this area. So what I'll be looking for is if price comes down to a point of interest, I could refine this on lower time frames. I could have point of interest here. I could have a point of interest here. We've got plenty of wick rejections across here. It lines up with this order block as well. Once it gets to a point of interest, I want to wait for a confirmation. One of the confirmations could simply be this: waiting for a doji to form plus a liquidity candle, and then a lot of the time what will happen is, let me just draw this. A lot of the time you'll get a doji to be formed, followed by a candle that wicks down, takes the low, and then starts pushing up quite heavily. So this would be a liquidity candle. Now, on this liquidity candle, what you do, now that you've got the confirmation that it's working, if you've missed taking the buy as it broke the low, then broke the high, you could wait and then say, okay, well, when it comes back down, what I can do is set a order to see if it comes back, because this is manipulation. This wick down is pure manipulation. It might come down and then retest the open of that candle again. Or it could come down and retest the tightest entry, but it might not catch it all the time, is going to be halfway of this wick. So you could be looking at entering somewhere here or somewhere here. And if this is a true manipulation, then you're not expecting it to break much further than this wick here. So you keep your stop loss relatively tight. If it breaks the low of this and keeps on traveling down, you don't want to hold a position in that direction going long, because it probably stop you out. So you want to keep your stop loss quite tight. You don't want to be using like necessarily percentage per trade. you more or less want to use like maybe fixed lots, small lots, so you know how much dollar value you're risking. Say it's like $10, $100, $1,000, and knowing that the risk reward for the upside is going to be much, much better, right? So now that I've got a point of interest, I've got an order block, imbalance here. I've got a doji here. So I've got a few little zones that I'm keeping an eye on. We just need to see how far price is going to go down. So what we can do is we can look and see, look into the lower time frames as well. One thing I'd be looking at is lower time frames, looking at the 5 minutes, and then investigating like how price moved up. So you can see like where this was. I'll go back to 30 minutes. Let me just get rid of this session so it's a bit cleaner. So you can see how like this is a 30-minute imbalance where the wick here and the wick there. From this wick to this wick, so I put a rectangle around the whole thing, and then where the colors are is just where the purple meets the green is just the halfway of that imbalance. When I go from 30-minute to 5-minute, I can actually refine this a bit further. So I can say, well, I've got a 5-minute imbalance here, and then I've also got another one just below it. So these become both points of interest that I'm looking at. I'm just waiting to see. I don't really want to see price drop down too much lower. I'd like to see it maintain above structure, and I've got a video on how I look at market structure as well, like structure 1, structure 2. But more or less, this is the market. So if it starts invalidating this level and breaking much lower than here, then I'm going to say, well, probably there's been a shift in market and that this area could become problematic for my buys. But as long as we're finding a support above here, then I'm inclined to be looking for buys, and that this was just a liquidity grab from London high, trapping early buyers, letting New York, because New York doesn't necessarily want to buy being so expensive up here. They would rather be able to trap some buyers, drive price down to a better price, a more attractive buy price for them, so they can buy at a lower price and then do their move as well. Because they've missed out from 1620s all the way up, and when they open at 1640s, so they've missed out on 200 pips. So it makes sense that they're going to drive price up to then just to sell it off, to drive it down lower, get a better price, and then for them to make their move. So what I'm looking at is these points of interest then. I'm waiting to see, and you might get it wrong a couple of times. That's why it's okay to give trades a second chance. But what I want to see is I want to see some sign of seller's exhaustion. I want to see some doji candles. I want to see some maybe some liquidity candles picking liquidity up, just so I know that support's been formed. So then we can drive price back up, at least to the London high, break the London high, and then push up higher. So what I'll do is I'll just play forward candles. So got like a little bit of a doji here. Now we want to see like something take the low and then drive up, or just drive down and then continue again, because this could just be bearish market structure forming. See how this takes the low? It takes the low, so this could have been a liquidity candle, but it didn't break the high. So this is too bearish for me to be wanting to jump in for any buys just yet, and it's not at my point of interest yet, not perfectly. So I can push forward again. See how it's just driving again, starting to get a little bit of wick rejection from this here, but it wicked down perfectly to the bottom of that imbalance and then found a rejection. So we know that when you've got these right, they are going to have reactions. It's just, is this the reaction that we want? It hit the low, rejected, but it's still a bearish candle. Price pushed up, started breaking the highs, but it hasn't actually faded out this move. So at this moment, price is still forming bearish structure until we're getting things closing above there. It's still bearish, so it's too soon to jump in yet. Find a little rejection from the top, little doji. Okay, so we're starting to see some manipulation creep into the market. Another little doji. Then price start breaking down. Nothing to do yet. Taps into this our point of interest again. Then drives down to the next one. Now we've got a doji. Okay, so this is the first time we've got a doji forming, and what this would be is people would see this straight away and then think, okay, what I'm going to do is I'm going to buy the high, put my stop loss below, and then target up here. And the trade would look something like this. This would be a typical retail trader strategy. And then if it's, or maybe to a higher interest, but I'm just going to say, let's just retest the high, because maybe we'll get like a higher time frame double top. At this point, what I'd look for is I could go through, and it's important to make sure you look at all different time frames, okay, just to see what's happening. For gold, because it's so fast, like on currencies, I wouldn't use lower than 5 minutes, but on gold, it's 10 times faster than currencies, so you could use 10 times lower time frames to look for these confirmations. So what I'd look for, I'm going to go down to the 1 minute, and what I really like is this is the pattern that I'm looking for. So that doji that we saw on the 5 minute time frame, when you look at the 1 minute, that's the pattern I'm looking for. I'm looking for, it doesn't have to be 1 minute necessarily, but I want to see a doji followed by a liquidity candle. When I see this is usually a very good sign that manipulation is starting to come into the market. So what we'd look at then is if this is your doji, this is your manipulation. So when price comes down, you could be looking for an entry from around here. Keeping quite a tight stop loss. So let's play it forward, because it's in our point of interest. Okay, this is in our point of interest, and now we're looking for this 1 minute. Price comes down, and see how it wicks down 50% of here. So this is the zone. This is your wick. You could be entering on the open of that candle, or looking for the 50% of that. Often that will be, these will be nice little areas to be looking for, keeping a tight stop loss under here somewhere. If it's starting to break the lows here and close below, the trade's invalidated and you want to get out of that one. So you don't want to hold onto these potential losers. So let's put that in. You'd be looking at something more or less like this, more or less. Okay, with refinement, it will be a bit better. Okay, you get more practice with it. So that's the price action I'm looking for. You can see like on the 5 minute time frame, that was on the 5 minute time frame, that was the doji. Okay, and then this is the candle that's wicking down and then taking that liquidity and now starting to push up. So the rest is history as it goes up. So that was a trade today in gold. I know this is like backtesting and hindsight in here, but it's just trying to give you like a little visual clues of what I'm looking at London highs, London lows, London 50%, session highs, looking for dojis, looking for liquidity candles, imbalances. I'll do more or less a video on each one in a bit more detail, a bit more specific detail, but just use that as a bit of a guide straight away on what you can be looking at. We'll do order blocks, we'll do a lot of other things, but this video is already 38 minutes, so I'm just going to finish this one now, upload it, and any comments, just put them in the chat, and I'll get to them. Okay, so thanks everyone for watching, and I'll catch you in the next video. Thank you.